Welcome to ASC 450 Contingencies, a masterclass on uncertainty. Every set of financial statements carries items that are not certain, lawsuits pending, warranties on products already sold, environmental obligations not yet fully quantified. The question ASC 450 answers is, when does that uncertainty show up on the balance sheet as a liability? When does it belong only in the footnotes? And when can it be set aside entirely? By the end of this session, you will be able to make that call with confidence for every contingency type you encounter in practice. Here is the first gate, and it is more important than most people realize. ASC 450 applies only when an obligation-creating event has already happened before the balance sheet date. Looking at the two columns here, the left side shows genuine contingencies. A lawsuit has been filed. Contamination has already occurred. Products have been sold with a warranty attached. A known regulatory violation happened before year-end. The right side shows what does not qualify. The general risk of future lawsuits from a product type, the possibility that future production might cause issues, the chance that future sales might generate higher claims, the risk of future regulatory changes. The key word in every item on the right is future. Nothing has happened yet. No past event has created an obligation. Without a past event, there is nothing to accrue and nothing to disclose under ASC 450. This distinction is the foundation of the entire standard. Misunderstanding it leads either to overstating contingencies by accruing general business risks, or understating them by waiting too long on things that have already happened. Once you have confirmed a past event exists, the next question is always, how likely is a loss? ASC 450 gives you three probability categories, and which one you assign determines everything else. On the left of the spectrum is remote, where the chance of occurrence is slight, generally below 5%. For most remote contingencies, you take no action. But notice the parenthetical on this slide. Exceptions exist for specific guarantees. That detail matters, and we will come back to it. In the middle is reasonably possible, covering the 5 to 50% range. More than remote but less than probable. Your action here is disclosure only. Describe the nature and the range in the footnotes. Do not accrue anything on the balance sheet. On the right is probable, where the future event is likely to occur, generally above 50%. If probable and estimable, you accrue. If probable but not yet estimable, you disclose and wait. And read the diagnostic note at the bottom carefully. These are not mechanical thresholds you apply by yourself. Probability classification for litigation requires written legal counsel opinions. The accounting team does not make that determination independently. Think of this flowchart as the engine you run at every period close for every known contingency. Two gates. Gate 1. Has a past event created a present obligation? If the answer is no, you stop. No accrual, no disclosure. You are dealing with a general business risk, not a contingency under ASC 450. If yes, you move to Gate 2. Is the loss probable? Here the path splits three ways. If remote, generally less than 5%, you stop. No action in most cases. If reasonably possible, you branch to disclosure only. You write the footnote without touching the balance sheet. If probable, you proceed to the estimability gate, which determines whether you accrue or disclose. Run this engine on every item. Do not rely on last period's classification, because new information may have changed the outcome. And do not skip items just because no lawsuit has been formally filed. A past event that has occurred is in scope regardless of whether legal proceedings have started. This table is your quick reference for any contingency question. 4 rows, each pairing probability with estimability, each with a clear accrual and disclosure answer. Probable and estimable is the active row, highlighted here in orange. You accrue at best estimate, and you disclose the nature of the contingency, the amount accrued, and any additional exposure above what you recorded. Probable but not estimable means no accrual yet, but you must disclose the nature and explicitly state that a reasonable estimate cannot be made. Reasonably possible, whether or not estimable, means no accrual but real disclosure. You describe the contingency and provide the range of possible loss, or state that no estimate is possible. Remote generally means no action, with the guarantee exception you already know about. Now look at the Step 4 rule at the bottom. This is critically important. The accrual you book is the floor, not the ceiling. If the full possible loss is larger than what you accrued, say you booked the minimum of a range, the full range must still be disclosed. Readers need to see the ceiling. The balance sheet shows the minimum. The footnote shows the maximum exposure. This is the rule that generates more measurement errors than almost any other in contingency accounting. So let us be precise. When a loss is probable and you have a range, say $100,000 to $300,000, but no single amount within that range is a better estimate than any other. US GAAP requires you to accrue the minimum of the range. In this example, that means booking $100,000 and disclosing the full range, explicitly noting that an additional $200,000 of exposure exists above the accrual. The disclosure is not optional. Now look at the trap on the right side. IFRS, specifically IAS 37, requires accruing the midpoint of the range when no better estimate exists. That would be $200,000 in this scenario. If you are working on a US GAAP engagement and you apply the IFRS midpoint rule, you have just overstated your liability by $100,000. This is one of the most common critical errors on US GAAP engagements, particularly when team members have mixed experience between the two frameworks. The minimum of range rule is a US GAAP-specific requirement. Know it. Apply it. Do not let it slip. Here is where a ASC 450 reveals its asymmetry, and it is completely intentional. Look at the two diagrams side by side. On the left, loss contingencies. Probable means accrue, reasonably possible means disclose, remote means no action. A graduated scale based on likelihood. On the right, gain contingencies. No matter where you fall on the probability spectrum, probable, reasonably possible, or remote, the answer is always no accrual. The only time a gain contingency gets recognized is when it is realized and legally certain. This asymmetry is not an accident. The principle is stated clearly here. Financial statements must never overstate assets or income before they are certain. That is conservatism built into the standard itself. The example at the bottom makes it concrete. Your company is countersuing someone and expects to recover $500,000. Legal counsel believes recovery is highly probable. Even so, do not accrue the gain. Disclose it in the footnotes, yes, but wait until the settlement is finalized or the court judgment is received before recognizing a single dollar of income. The moment companies start booking probable gains is the moment their income statements start reflecting optimism instead of reality. A ASC 450 does not allow that. When you have a litigation contingency, the accounting team cannot make the probability call alone. The left side of this slide lists what you need from legal counsel before you can complete your analysis. You need the current status of the matter, whether it is in discovery, at trial, or in settlement discussions. You need counsel's view on the merits and the strength of the claim against the company. You need an explicit probability assessment. You need an estimated range of possible damages. And if there is insurance coverage involved, you need those details too. Now the right side addresses something that trips up even experienced teams, the gross presentation lock. Say you have a litigation liability of $500,000 and an insurance recovery receivable of $300,000. Can you present a net liability of $200,000 on the balance sheet? No. Both amounts must appear gross and separately. The liability on one side, the receivable on the other. You can only offset them if a strict legal right of offset actually exists, not just an expectation that insurance will pay. And recognize the insurance receivable only when recovery is independently assessed as probable. That is its own probability analysis, entirely separate from the assessment of the loss itself. Watch out for this one. It is the most common completeness failure in contingency accounting, and the radar screen visual captures exactly why. At the surface, you can see filed lawsuits. Those are visible. Your legal register captures them. But below the surface sit the unasserted claims, potential obligations that exist because a past event has already occurred, even though no legal document has been served yet. 3 examples on this slide. First, a known IRS audit where adjustment is likely. A probable assertion from the IRS is a contingency, even before any formal notice arrives. Accrue it if you can estimate the amount. Second, pre-year-end environmental contamination. The contamination is the past event. If regulatory action is probable and cleanup costs are estimable, you accrue now. You do not wait for a notice of violation or a regulator's visit. Third, an escalating customer dispute where no formal claim has been filed yet. Evaluate the facts with counsel and accrue if the analysis supports probable and estimable. The trap at the bottom states it precisely. Do not just review the litigation log and call it done. The right question at every period close is, has a past event occurred before this balance sheet date that could trigger a claim? That question opens a much wider net than a list of active lawsuits. Warranties are one of the most common loss contingencies you will encounter, and the key rule is, accrue at the time of sale, not when a claim is submitted. The sale itself creates the obligation. The product is in the customer's hands. The promise to repair or replace it has already been made. The fact that no one has called in a claim yet does not change the accounting. You estimate the liability using historical defect rates, average repair cost per claim, the length of the warranty period, and any known product issues. Looking at the waterfall here, the math is straightforward. You start with a $40,000 opening balance. During the year, sales were $5 million, and the historical warranty claim rate is 2%, so you add $100,000 of warranty expense. Actual claims paid during the year totaled $30,000. Closing liability, $110,000. Simple math, but the disclosure is not optional. The roll forward itself, showing opening balance, current year expense, claims paid, and closing balance, must appear in the financial statement footnotes. It is a mandatory disclosure. Reassess your warranty estimates at every reporting date. If actual claim experience diverges from your historical rate, update the estimate prospectively and disclose the change. Guarantees catch people off guard more often than they should, so let us be clear about the rule. Every guarantee arrangement must be evaluated for potential recognition under a SC 450, and in some cases, a SC 460. And every guarantee requires disclosure, even when no accrual is triggered. Looking at the 3 types in the table, parent guarantees of subsidiary debt, seller indemnifications given to buyers in acquisitions, and affiliate lease guarantees. For all 3, the accrual trigger is the same. Accrue when it becomes probable that the guarantor will need to perform and the amount is estimable. But look at the disclosure column. For parent guarantees, disclose the maximum potential payments and the carrying amount of any liability. For seller indemnifications, nature, term, and maximum exposure. For affiliate lease guarantees, always disclose. Now the alert at the bottom is the one most teams miss. Even if the probability of having to perform on a guarantee is purely remote, even if you are completely confident you will never be called, the maximum potential payment still requires disclosure. This is the exception to the general rule that remote contingencies need no action. Guarantees are different. If your company has written any parent guarantees on subsidiary borrowings, indemnification clauses in sale agreements, performance bonds, those all need to be on your disclosure radar regardless of how unlikely a payout seems. Environmental liabilities have a recognition trigger that surprises people. You do not wait for a notice of violation, a regulatory agency visit, or a formal enforcement order before accruing. The trigger is the contamination itself. If contamination occurred before the balance sheet date and regulatory action is probable, You accrue as soon as the costs are reasonably estimable, regardless of whether any regulator has contacted you. The slide lays out exactly what goes into the estimate. On the included side, investigation and assessment costs to understand the scope of the contamination, cleanup and remediation costs, legal and consulting fees directly tied to the remediation work itself, and site restoration and ongoing monitoring costs if those are part of the probable obligation. On the excluded side, general legal fees not directly related to the remediation effort. Those are period expenses, not part of the environmental accrual. The distinction matters because environmental matters often involve large legal teams, and not all of that legal spend belongs in the environmental liability. Remember that environmental matters are also a classic unasserted claim scenario. The contamination has happened. No one has formally noticed yet, but the obligation exists. Your period-end review needs to catch that. Sales incentive programs, loyalty points, coupons, rebates, free gifts with purchase, create contingent liabilities, and the matching principle tells you when to recognize them. The obligation arises when the product is sold and the coupon or loyalty credit is issued. You cannot wait until customers actually redeem. The formula here is clean. The company has sold 200,000 units. Each unit includes a coupon redeemable for a free accessory costing $4. Based on historical data, 60% of coupons are actually redeemed. Multiply those three numbers. 200,000 units times $4 times 60% equals $480,000 of estimated premium liability. The journal entry: debit premium expense for $480,000. Credit premium liability for $480,000. This expense hits in the same period as the sales that generated it. That is the matching principle doing its job. When customers actually redeem their coupons in future periods, you debit the premium liability and credit inventory or cash. The liability unwinds as redemptions occur. The key variables to update at every reporting date are the historical redemption rate and the cost per redemption. If your 60% assumption turns out to be running higher, the liability needs to increase prospectively. Here is where it gets interesting, and where people get into trouble if they apply standard ASC 450 rules without recognizing the exception. In a business combination, the normal probability and estimability thresholds do not fully apply at the acquisition date. ASC 805 takes over, and the treatment depends on whether the contingency is contractual or non-contractual. For contractual contingencies, those that arise from a contract, you recognize them at fair value on the acquisition date regardless of whether a loss is probable or estimable under ASC 450 standards. Fair value measurement replaces those tests entirely. This means some contingencies get recognized in a business combination that would not yet qualify for recognition if the same company were reporting standalone. For non-contractual contingencies, like a pre-acquisition lawsuit, you apply a probability test. Recognize it only if it is more than 50% probable that it meets the definition of an asset or liability. After the acquisition date, both types are subsequently measured at the higher of the initial fair value recognized at acquisition, or the amount you would calculate under a SC 450 at that later date. That higher of rule prevents you from releasing contingency liabilities too quickly after a deal closes. The period between your balance sheet date and the date your financial statements are issued, the subsequent events gap, is not a dead zone. Evidence that emerges in that window can and often must affect what you report at year end. The key distinction is whether the new information relates to conditions that existed on the balance sheet date or conditions that arose afterward. An adjusting event. A lawsuit was pending at December 31st. In February, before the statements are issued, the company settles for $150,000. That settlement is evidence about the value of the obligation that existed at December 31st. You adjust your accrual to $150,000. The The settlement price tells you what the liability was actually worth at year-end. A non-adjusting event. A brand new lawsuit filed in January based on an incident that happened in January. That condition did not exist at December 31st. You do not accrue it. You disclose it if material, but the December 31st balance sheet is not adjusted. The practical takeaway: stay in contact with legal counsel right up to the issuance date, not just as of year-end. Legal confirmations obtained after year-end, but before issuance, are adjusting evidence. They shed light on conditions that existed at the balance sheet date. You want that information before the statements go out. 2 foundational journal entries. Let us walk through both cleanly. The first is the accrual entry when a loss is probable and estimable. You debit a loss expense, labeled to the nature of the contingency, whether that is litigation loss expense, environmental remediation expense, or similar, and you credit an accrued liability on the balance sheet. The amount is your best estimate, or if you only have a range and no amount within it is clearly better, the minimum of the range under US GAAP. The second entry is settlement, when the matter resolves and cash goes out. You debit the accrued liability and credit cash. That is the clean case. Now look at the settlement variances. If the final settlement is larger than what you accrued, the difference is additional loss expense in the current period. If the settlement is smaller than the accrual, the matter resolved more favorably than expected, the excess reversal goes to gain on settlement in other income. Changes in estimates are always recognized in the current period. You never restate a prior period because a contingency settled for more or less than you expected. That prospective treatment rule applies every time an estimate changes, and it applies here too. 4 more journal entry patterns that complete the contingency accounting toolkit. Top left, the warranty life cycle. At the time of sale, you debit warranty expense and credit warranty liability. The obligation is created the moment the product is sold. When actual warranty claims come in, you debit the liability and credit cash or inventory. The expense was already recognized at sale. This second entry just settles the liability as claims are fulfilled. Top right, guarantee accruals. When it becomes probable that your company will need to perform under a guarantee, say a subsidiary is struggling to service its own debt, you debit guarantee loss expense and credit a guarantee liability. Same probable and estimable logic as any other loss contingency. Bottom left, unasserted environmental. When a past contamination event makes a remediation obligation probable, you debit environmental remediation expense and credit an environmental liability before any regulator has shown up and before any formal notice arrives. The past event is what triggers it, not the regulatory response. Bottom right, highlighted in orange because it surprises people, releasing an overaccrual. When a matter settles for less than you accrued, you do not quietly reduce the liability to zero. You debit the accrued liability and credit gain on settlement or reversal of contingency. That gain flows through the income statement visibly. Readers can see when contingencies resolved more favorably than expected. Where does a contingent liability actually appear on the financial statements? 2 things determine that: expected settlement timing and the nature of the item. On the balance sheet, the split follows the standard current and non-current rule. If settlement is expected within 12 months, the liability goes in current liabilities, labeled accrued liabilities, warranty liability, or litigation accrual depending on what is clearest. If settlement extends beyond 12 months, a multi-year environmental remediation, or a litigation matter not likely to resolve for 2 or 3 years, it sits in non-current liabilities. On the income statement, loss contingency expense from litigation and warranties runs through operating expenses. Gains on final settlement, when a matter resolves more favorably than accrued, appear in other income. And gain contingencies, shown in orange here, are never recognized in the income statement until they are actually realized. Now the netting prohibition at the bottom. This comes up every time insurance is involved. You cannot net the insurance recovery receivable against the loss contingency liability on the balance sheet. Even if you are highly confident the insurer will pay, the two items sit separately, the liability on one side, the asset on the other. They are only offset if you have a legal right of offset, not just an expectation of payment. Auditors test this specifically. Make sure your balance sheet reflects both amounts gross. This checklist is what separates complete disclosure from deficient disclosure, and the item in the orange box is the one that most commonly fails in practice. Work down the list. For any accrued contingency, disclose the nature, the amount you accrued, and the full range of possible additional exposure above the accrual. If you book the minimum of a range, the reader must see the ceiling. For probable but not estimable, disclose the nature and state explicitly that no reasonable estimate can be made. Do not just accrue zero and go silent. For reasonably possible, highlighted in orange with a watch-out label, you must disclose the nature and an estimate of the possible loss or range, even though nothing appears on the balance sheet. No liability, but still a required footnote. This means your contingency register cannot be limited to items that have been accrued. Every reasonably possible item needs a disclosure. Maintain a complete register. For warranties, your footnote needs the accounting policy and the full mathematical roll forward showing opening balance, current year expense, changes in estimate, claims paid, and closing balance. For guarantees, nature, term, triggering events, maximum potential payment, and any recourse or collateral rights. Work through this list for every item at every close. The most common audit finding in contingency accounting is not a wrong number. It is a missing disclosure. This diagram brings the entire standard together into one life cycle. Internalize these 5 phases and you will never miss a step. Phase 1, inception. A past event occurs, a lawsuit is filed, contamination happens, a product is sold with a warranty. That past event is the starting gun. Phase 2, at every period close you apply the decision engine. Has the past event created a present obligation? Is the loss probable? Is it estimable? Your answers determine the action. Phase 3, financial output. Balance sheet accrual, income statement expense, and footnote disclosure, reflecting whatever the decision engine produced. Phase 4, highlighted in orange because it is where most teams cut corners, the reassessment loop. This is not a one-time exercise. At every reporting date, you return to Phase 2 with fresh information. Has the probability changed? Has a better estimate emerged? Has new evidence appeared in the subsequent events window? Changes in estimates are recognized in the current period, prospectively, no prior period restatements. The arrow loops back to Phase 2 because the cycle does not stop until resolution. Phase 5, resolution. A final cash settlement closes the matter, or the risk expires without a claim. The liability is released. Any difference from the accrual flows through the income statement, and the contingency life cycle ends. We close with the 7 most common errors in a ASC 450, the mistakes that appear in audit findings, restatements, and SEC comment letters. 1. Ignoring unasserted claims. Your review cannot stop at the litigation log. Ask whether any past event has occurred that could trigger a claim, regardless of whether a lawsuit has been filed. 2. Accruing gain contingencies. No matter how probable a gain looks, you do not accrue it until it is realized and legally certain. Disclose it, but do not book income prematurely. 3. Applying IFRS rules on a US GAAP engagement. When no better estimate exists in a range, US GAAP requires the minimum. The IFRS midpoint does not apply. 4. Netting insurance recoveries. The insurance receivable and the loss liability must sit separately on the balance sheet. No netting without a strict legal right of offset. 5. Accruing business risks. Future economic risks and possible future events without a past triggering event are not contingencies and must not be accrued. 6. Set and forget accounting. Every contingency must be reassessed at every reporting date. An estimate set at year-end is not valid for life. 7. Missing reasonably possible disclosures. If it does not hit the balance sheet, some teams think no disclosure is needed. That is wrong. And the statement at the bottom is the most important thing to take from this entire masterclass. The highest risk in contingency accounting is not calculating the wrong amount. It is failing to identify the risk at all. Completeness is everything. Thank you for watching. Thank you for watching. Subscribe for more training from PNJ Group.